एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
So, good afternoon, friends. Welcome to this second day of this tax audit series on the Saraswathi Pooja series. At the outset, I want to thank once again to all the speakers, and today especially to CA Chaitanya, who I think I invited him at a very short notice. Apologies for that, but I think you've risen up to the challenge and you've come here today, and I'm sure you're going to, as usual, deliver an outstanding session on Form 3CB, I think clauses 1 to 13 in particular, the general information. Friends, we are trying to do a clause by clause analysis. Okay. Otherwise, why don't you read out Sir's profile? I thought I'll introduce, but if it's going to break in between, I don't want it to be an disconnected introduction. So friends, I have a technical issue here. I want to place on record my appreciation to CA Chaitanya once again, and I'm sure that he's going to do an outstanding job today. I will hand over the proceedings to CA Ratnavel to first introduce Chaitanya sir to us, and then the proceedings will be handed over to him. Yeah, Ratnavel, you can proceed.
Okay, madam.
Yeah.
On behalf of ICA, I am very happy to introduce today faculty CA Chaitanya. He's a postgraduate in commerce from Sri Venkateswara University, Tirupati, qualified chartered accountancy in January 2005, qualified the information systems audit course of ICA, completed the certification course of ICA on international taxation. Also, he completed a bachelor's degree in law in 2020, pursuing master's degree in international taxation from Nalsar University, Hyderabad. So he is practicing from 2005. He has varied experience in statutory audits, internal audits, and tax audits. Clientele include various listed and unlisted companies, banks, insurance companies, trusts, firms, and other entities. Has been representing before various income tax authorities and has also been actively involved in the preparation and representation of appeals before CIT and ITAT, Hyderabad and Chennai. Has written articles on direct taxation for Chartered Accountants Study Circle, Chennai, and International Fiscal Association, Chennai chapter. Specializes in direct taxes with keen interest in international taxation. So with this short introduction, I would like to welcome today speaker C.A. Chaitanya to the virtual session. So welcome, sir, and over to the speaker.
Thank you. Thank you, Ratnavel, sir. At the outset, I would like to thank Chairman SIRC, Revati Raghunathan ma'am, for giving me this opportunity. After a very long time, I'm addressing a session on Zoom, so I believe my presentation and my voice is both audible to all the audience here. I would continue for the next 1 hour, 45 minutes or so, and we will have some time of 15 to 20 minutes of time for the question answer session on the issues that I would be covering today. At the in the initial backdrop, when I was approached to speak on this clause 1 to 13, referring to the basic characteristics of, the basics of tax audit, and after that 19 to 29 also. I was wondering what should I cover? Income tax is not new. Everybody has done tax audit several years. So what is new that I should present to them? But I thought I'll just try and refresh your knowledge on the concepts. There are very few changes which have come in for the current year, but otherwise, most of the clauses continue to remain the same as old year. Wherever there are changes, I'll specifically cover what are those changes. Otherwise, we will try and refresh our existing knowledge on what does the clause require us to do and how should we approach with the reporting aspects. The material on tax audit has been quite cumbersome. In fact, if one were to start studying the material just before the season, it would be very difficult to complete, considering that it is all voluminous. So this is just a quick snapshot on the kind of materials that we have. We have the guidance note, which is changed year after year. Presently we have the 2025 guidance note on tax audit. We also have the QRB reporting. QRB is the Quality Review Board. There is a TAQRB called as the Tax Audit Quality Review Board. It has issued a study on all the compliances and the errors that it has found out on examining various tax audit reports. And we also have a technical guide on ICDS, and we also have a checklist issued by ICI. The checklist is available both in the PDF and the Word format. All this material is available for free for download from the institute website. So whoever requires an approach, or whoever requires these material can happily download it from the ICI website. And for the tax audit purpose, these are the key materials from which we'll have to derive our guidance. Any approach beyond this, any approach which is in violation of the matter laid down in these books would require adequate support from the legal background. Otherwise, you are sure to end up in trouble. So ensure that whatever you follow, whatever you report in your Form 3CD is strictly in accordance with the methodology laid down in these books. So before I start the lecture on clause 1 to 13, I thought I'll just update you on this Tax Audit Quality Review Board. Tax Audit Quality Review Board is the regulatory arm of the institute, especially relating to tax audits. So this board, under its purview, it can review any report, not just Form 3CD. It can review any report which is issued by a chartered accountant, either under the income tax law or under the GST law. And that report could be examined to check whether all the reporting requirements laid down under the law have been strictly adhered to or not. If the reporting requirements are adhered to as per the income tax law, do they also conform to the in compliance with the pronouncements, guidance notes, or technical guides issued by the ICI? So we'll have to balance the reporting requirements laid down by the Income Tax Act and the institute requirements together. We should ensure that they are properly placed in the tax audit report in Form 3CD. So as I said, this TAQRB is the regulatory arm of the institute. In case the TAQRB finds that the reporting is not adequate, there is a material non-compliance with the guidance given in the guidance note, then those cases could be referred to the disciplinary directorate of the institute. If there is no material non-compliance, but there are immaterial non-compliances, then to that extent, the tax auditor would only be cautioned, would only be at best intimated that these should not repeat again. But otherwise, TAQRB has been very strict in ensuring that their disciplinary cases are adequately referred to the institute wherever required. So to that extent, ensure that there are no non-compliances as far as the TAQRB is concerned. Throughout my presentation, after each class, if at all it is applicable, I will try and take you to the TAQRB's remarks that has been placed with respect to those clause. For each clause in Form 3CD, in the book compiled by the TAQRB, they have issued guidance where they found that there has been discrepancies in the reports that they have examined till 2022. So to that extent, we need to ensure that they are in compliance with the TAQRB also. The report of TAQRB is not unique. It only takes the compliance requirements from the guidance note and checks it with the tax audit reports issued. So wherever there is a tax audit report issued, to that extent, if it deviates from the guidance note of the institute, then to that extent there will be a disciplinary case as far as the TAQRB is concerned. In this whole gambit, the problem is that the time for compliance of the time for reporting as far as a form 3CD is concerned is always inadequate. We have very short duration within which we'll have to complete the audit, ensure that the accounts are properly prepared, get them audited, and then we'll have to also compile the reporting requirements as given in form 3CD. So with this backdrop, we'll have to go in for examination of the disclosure requirements under each clause. Before I go to the first clause, I would also like to tell you that you'll have to check what is the applicability of the tax audit vis-a-vis the SSE. I'm sure the previous auditor would have, the previous session would have covered on the applicability of the tax audit, but where the applicability has been examined, we should also ensure that there is adequate documentation in place, without which compliance with the tax audit requirements would be very, very difficult as far as an reporting under the tax audit is concerned. Now, what do I mean by documentation? One thing is for sure, the accounts have to be prepared and compiled into the financial statements as per the framework given either under the existing law or under the accounting standards issued by the institute, and also in accordance with the framework laid down by the institute. What do I mean by framework? In case of a non-corporate assessee for the current year, the manner of presentation of financial statements has been deferred by 1 year. But in case of corporate assessees, the form and the content in which you have to prepare the financial statements is laid down. Similarly, in the case of an LLP, there could be a format of financial statements that could be laid down under the law. So where a law regulates the presentation of financial statements in a particular format, to that extent, the format of the financial statements have to be complied with. Where there is no law in place, then to that extent, financial statements can be prepared, but the underlying essence of that financial statement, the underlying accounting standards to be followed, would necessarily have to be with those issued by the Institute of Chartered Accountants of India. And to be even more precise, you cannot prepare the financial statements in accordance with the income tax computation and disclosure standards. ICDS are meant to compute your total income. They are not meant to prepare your financial statement. So for all practical purposes, financial statements should be in the should follow the accounting standards laid down by the institute, and wherever there is a deviation from the accounting standards, to the extent the ICDS differs, it has to be used only in the computation part, not in the financial statements. And it goes without saying that financial statements should be accompanied by the significant accounting policies and the notes on accounts wherever required. And while assessing the complaints with the guidance note, the TAQRB had compared the notes on accounts of the assessee with the financial statements and the reporting requirements as per the particular clause of that, and wherever there has been discrepancy, the QRB has issued a observation for the assessee. So we'll now proceed to see each clause one by one to see what is to be reported, what is the guidance of the institute, and what is the observation of the QRB. First and second clause deal with the name of the assessee and the address of the assessee. What do I mean by name of the assessee? Name of the assessee would only refer to a case where an assessee has, for example, an assessee is a sole proprietor. He is the person who is carrying on his business. Then the name of the assessee to be reported is the name as appearing in his PAN. If the assessee has a trade name apart from the regular sole proprietorship name, then even the trade name has to be reported. For example, if the name of the assessee is Chaitanya and if he is carrying on a business in the name of, say, Chaitanya sole proprietor or Chaitanya traders, then even the trade name has to be included along with the name of the assessee. So it's not just the name, but the name along with the trade name has to be included as the name of the assessee. Where the auditee, where the person who is getting audited is a branch of a main assessee, then in those cases the name of the assessee would be the main assessee along with the branch where which is being subjected to tax audit. So in those cases it would not just be the name of the assessee, but the name of assessee accompanied by the branch of the assessee also. Both have to be mentioned in the place where there is name of the assessee. Address, what is the address to be given in Form 3CD? In fact, address is quite difficult to be mentioned exactly. I know for sure that where there are companies which have been registered, in those cases the registered office address would be available as per the records of the ROC. So to that extent, in the case of a company, you can mention you should mention the registered office address of the assessee. But what happens to a non-corporate assessee where there is no registered office address? The guidance note of the institute says that the address to be mentioned in clause 2 should be the same one which has been communicated by the assessee to the income tax department as on the date of signing of the report. There could be instances where the address is mentioned in the PAN application. There could be instances where an address is registered on the income tax portal in the profile section, and there could also be an address which is given in the return of income of the assessee, the previous return of income of the assessee. So which is the address which has to be reported? Essentially, of all the three, the address, the principal place of business of the assessee has to be reported as the address of the assessee. The main place where the assessee or head of the assessee sits is the place where it is treated as the principal place of business, and that is the business address which has to be reported to the department. Now, which has to be reported in Form 3CD clause 2. If the assessee has multiple businesses, and each business has got a different location, then you will have to mention all the addresses to the under clause 2 of Form 3CD. Where it is not possible to give all the addresses, probably you can enclose it along with the part of your financial statements, but it would be ideal to mention the principal place of business of the assessee. Now, what happens if there is a change of name or address? If there is a change in the name or an address and it happens prior to the close of the financial year, then to that extent, that has to be reported in Form 3CD itself. To that extent, it has to be reported in Form 3CD itself. And the last address as on the close of the financial year, that is the last address as on the close of the financial year, which is on 31st of March of every year, will be the address which will be reported in clause 2 of Form 3CD. But what happens where there is a change in the address after the close of the financial year, but before the issuance of the tax audit report? In those cases, probably you can still go ahead and issue you can mention the old address itself under clause 2, but you'll have to give an observation in your Form 3CD saying that there has been a change in the address of the assessee after the close of the financial year. The institute's guidance note only says that where there is a change in the name or change in the address of the assessee, that too after the close of the financial year, then to that extent the attention has to be brought to the attention of the department has to be brought to the change in the address. If there is a change in the name which happens prior to the close of the year, then you will have to mention both the old name and the new name of the assessee. But after the close of the year, it is not necessary that you should mention the details. You should only make an observation, which would be sufficient. The new name need not be mentioned in Form 3CD is what is the guidance note saying about. The QRB, while reviewing various tax audit reports, noticed that the annual report's address or the registered office address is different from the address mentioned in Form 3CD, which is considered as a serious departure. So ensure that what is reported in Form 3CD complies with your ROC registration certificate where your registered office is specifically mentioned. So this is all about the clause 1 and clause 2 of Form 3CD with respect to name and address. With respect to clause 3 to clause 7, clause 3 talks about your permanent number or your Aadhaar number. I have the form 3CD with me. If you look at the form 3CD, it says permanent account number or Aadhaar number. So which one should be given? Should you give your permanent account number or should you give your Aadhaar number? For all practical purposes, everyone here would know and everyone here would agree with me that it is not possible to file a form without your PAN number. So obviously an SSC would always have the PAN number. So PAN number is mandatory in form 3CD. Aadhaar number is only optional. So if you have a PAN, you can give your PAN. If you intend to give your Aadhaar, you can give your Aadhaar. It is only an optional number. But if that is not the case, then giving PAN is mandatory. And we all agree that for all practical purposes, giving without a PAN number, one cannot file form 3CD. So for that reason, we'll have to necessarily disclose PAN as far as clause 3 is concerned. Where an SSC is liable to pay indirect taxes, then in clause 4, you will have to furnish the registration number or the GST number of all the registrations that you have as far as your indirect taxes are concerned. There are still SSCs who are paying excise duty, which are not within the GST purview. There are still SSCs which could be liable for sales tax, not coming within the purview of GST. You could have SSCs which are coming within the purview of GST. You could have SSCs where along with the GST, they would also have some customs duty payments arising out of their normal regular course of business. In those cases, all the registration numbers under all indirect tax laws have to be given. You cannot restrict yourself only with a GST number. Even with the GST number, you could have registration in several states and you could also have an ISD registration number. All those registration numbers have to be given in the form 3CD. You cannot restrict yourself with one number or two numbers. It is required to give all the numbers as far as clause 4 is concerned. QRB noticed that in several cases, there have been instances where the GST number is not matching with the disputes of liabilities disclosed under Caro audit report. QRB also noticed that some of the numbers that were reported were not matching with the PAN, because GST essentially would have a PAN number inbuilt into its registration. So for all these reasons, QRB raised issues as far as the numbers disclosure of numbers, registration numbers is concerned. So if you can understand the issue that QRB is raising, you will understand how seriously QRB has been looking into the compliance with various disclosures under each clause. So ensure that only the correct numbers are reported as far as clause 4 is concerned with respect to GST or any other indirect tax laws. The institute only says that as far as the guidance note is concerned, it says it is always advisable to take a written representation letter from the management with respect to their GST or any other indirect tax laws numbers. So it is always advisable to maintain the working papers in the format prescribed in the guidance note, which is appearing on your screen. So in that format, you will have to take the representation from the management. You will also have to ensure that this is cross-verified with the registration certificate issued under the respective laws. Thereby, if you can properly ensure that the correct numbers are reported, you will have less difficulty or lesser number of issues as far as a QRB verification is concerned. Clause 5 to 7 are very simple. Clause 5 talks about the status. You will have to report what is your status. Are you a individual? What is the category of person that you are? Are you an individual or are you a HUF, or you fall under any other category like company, AOP, BOI, or artificial judicial person, or the firm including an LLP. LLP for all practical purposes is treated as a firm because the definition of the firm states that the firm includes an LLP. So for that purpose, LLP is categorized as a firm. So depending on the status of the SSC, you will have to pick the necessary status. Ensure that your PAN also correspondingly has the same status as that of what is mentioned in clause 5. As far as the previous year is concerned, previous year is a uniform year preceding the assessment year. The definition of previous year, it says it is from 1st April to 31st of March of the previous year corresponding to the assessment year. In case where there is a new assessee, he is newly commencing his business, for that year alone, the previous year would start from the date he incorporates or he commences his business till 31st of March. That will be the only case where the previous year is not from 1st April till 31st of March. It will be a shortened period of a previous year. So for those cases, you will have to take only from the first day of the assessee till the date he till 31st of March of the till the 31st of March of the corresponding assessment year. So one year before the assessment year. Amalgamations or demergers happens. In those cases, the previous years could change. So in cases where there are amalgamations or demergers, you will have to see what is the assessment year for the amalgamated company or amalgamating company, and similarly for the demerged or the resultant company, what could be the previous year, especially in the case where the resultant company is formed after certain months. You will have to ensure that the previous year is appropriately given wherever there is a corporate restructuring happening. Clause 7 talks with the assessment year. Any the year from 1st April to 31st of March following the previous year is your assessment year. Till the Income Tax Act 2025 comes into picture, assessment year always succeeds the previous year. So to that extent, probably this is the penultimate year where we'll report previous year and assessment year separately. In the next Form 3CD would be the last Form 3CD where we'll report previous year and assessment year separately. From 1/4/2026 onwards, when the new Income Tax Act comes into picture, I am sure you would all know that they have merged the concepts of previous year and assessment year into one year called as the tax year. So to that extent, till that comes into picture, we'll have to report the previous year and assessment year as far as Form 3CD in Clause 6 and 7 separately. Coming to Clause 8, Clause 8 talks about giving out the relevant clause as per Section 44AB of the Income Tax Act. Whatever is the relevant clause, that has to be reported in the tax audit report. I am sure most of you would be having a private software like Winman, Computax, or any other software where the moment you start entering the data, the software automatically picks the relevant code for you. But where most of you are using, cases where you are using the department Excel utility or department online utility, in those cases, this relevant clause has to be filled manually. Even in cases where there is a software which is doing the job, you will have to ensure that the software is filling up the correct code. 44AB Clause A talks about a business case where the turnover exceeds 1 crore and therefore liable for tax audit. Clause B talks about a profession where the gross receipts exceed 50 lakhs. Clause C to Clause E talk about opting out of the presumptive tax. Clause C and Clause D talk about a case where you are not opting for the presumptive tax under 44AE, 44BB or 44BBB. That is mostly for non-residents. 44AB Clause D talks about presumptive tax under 44ADA. So in the case of a specified business, I am sure this would have been covered in the previous session dealing with applicability of tax audit. But nevertheless, I'll take a minute in explaining the scenario behind the respective clause. In case you are a specified profession, in case you are having a specified, if the assessee is having a specified profession, if the turnover or the gross receipts from that profession is below 50 lakhs, then necessarily he will have to decide whether he would like to opt for presumptive taxation under 44 ADA or would he like to go under 44 AB tax audit. In those cases, if he is not opting for 44 ADA, in those cases, the respective clause to be chosen is 44 AB Clause D, where the turnover or the gross receipts of the professional assessee exceed 50 lakhs, he would no longer be compelled to go under 44 ADA. He would no longer be required to follow 44 ADA, because 44 ADA is applicable only in the case of an assessee whose gross receipts is below 50 lakhs. Since the gross receipts exceeded 50 lakhs for a professional, he would have to necessarily follow 44AB clause B. So understand the difference. Profession, if it is below 50 lakhs, if he is not opting for a presumptive tax, the respective clause is 44AB clause D. If a professional whose turnover exceeds or gross receipts exceed 50 lakhs, then to that extent, the reporting clause would be 44AB clause B. Similarly, in the case of an SSE whose turnover has not exceeded 2 crore rupees, I am not taking for a minute that 3 crore limit. But if for an SSE, if the turnover has not exceeded the 2 crore limit, and he was erstwhile in the 44 AD regime, he is supposed to be in 44 AD regime for 1 year plus 5 years. So he would be there for 6 years in the total. That would be considered as the block period. If he's coming out of the block in any time during those 6 years, if he's coming out of the block, then in those cases, he will be subjected to tax audit under 44AB. In those cases, he'll have to be under tax audit for that year plus the next 5 years. In all the 6 years, he will have to report it as 44AB clause E. He cannot go and report it under 44AB clause A. He will have to report it only under 44AB clause E. So if a person is opting out of presumptive tax under 44AD4, he will have to come within the, he will have to report it as 44AB clause E and not clause A. While the QRB observed various reports, especially dealing with those who are coming out of the presumptive tax, most of the reports they have chosen it as clause 44AB clause A, which is incorrect. The QRB states that you should have ideally reported it as 44AB clause E. It would be most important for the chartered accountant for the simple reason that your count of 60 only takes into consideration clause A and clause B. It does not take into consideration clause C, D and E. So therefore, please be very, very careful. Ensure that you are reporting the correct clause as far as clause 8 is concerned. Respective clause of 44AB needs to be correctly reported in clause 8 of form 3CD. Clause 8A, which has subsequently been introduced, clause 8A is now talking about whether an SSE has opted for taxation under 115BA, BAA, BAB, BAC, BAD or BAE. These are all preferential or beneficial taxation regimes which have been bestowed to an SSE. BAC is essentially applicable to an individual. BAA or BAB is applicable to a company. BAD and BAE would cover societies and other SSEs respectively. So each section has a particular applicability. Each section is applicable only to one category of an SSE. So you will have to ensure whether your SSE has opted for taxation under the respective regimes. See, as far as an individual or a HUF is concerned, especially an individual case, 115 BAC is a default regime now. It is a default regime. If you are opting out of 115 BAC, you will have to file the respective form in form 10 IEA or whatever is that applicable form. In that form, you will have to mention that you are opting out of the default regime, which is 115 BAC regime. So if at all you have opted for taxation under the respective regime, you will have to say yes. If you have not opted for, then you will have to say no. In fact, the disclosure is much more elaborate as far as the form, ITR form is concerned. At least to the extent of form 3C, the disclosure is minimal. It only says say yes or say no. With regard to recommendation under the guidance note, they said kindly take a written representation from the SSE. You also examine the forms that have been filed as far as the respective sections are concerned for opting out. If at all they have opted out, then you will have to if at all you have opted out, then you will have to report it as no as far as the SSE under that respective tax beneficial taxation regime is concerned. I see that there are few people who have raised their hands. If it is okay, then I will take all the queries in the end. But if you think that is not the case, then probably you can unmute yourself and ask me wherever required. But I believe we can take all the queries in the end so that I'll try and finish my entire presentation and it will not be hindering others who are listening to this presentation. So Institute's recommendation in the guidance note has been that there should be a written representation from the SSE wherever he has opted out, and that should correspondingly be verified with the forms filed. But what happens? The SSE usually has a 1 month time period for filing his return. So during the tax audit report, if the SSE says no, I will stay in 115 BAC, but after the audit report has been filed, the SSE changes his stance and says, no, I would like to opt out of 115 BAC because that is more beneficial to me. Then what is the situation? There could be an instance where the audit report says one thing and the SSE could do another thing. In all those cases, it is always advisable to change the report or revise the audit report. Although it is not strictly in accordance with Rule 6E, it is better that the audit report can be amended to ensure that there is adequate disclosure in the correct form. And for all practical purposes, the SSE should be asked to decide at the time of audit report itself whether he is opting for 115 BAC or not, or the respective sections. If at all the SSE has not made up his mind, then it would be correct to file an audit report based on his written representation. Thereafter, revise the audit report if at all there is a change in the stance. Clause 9 talks about the profit sharing ratio. Clause 9 simply states that for a partnership firm, you will have to indicate the names of the partners and their profit sharing ratio. If it is an AOP, you will have to indicate the names of the partners and their profit sharing ratio. If there is a change in the profit sharing ratio, that change also has to be disclosed. If there is a simple change in the partnership profit sharing ratio, it could tantamount to a reconstitution of the firm also. There are other consequences, but nevertheless, for the purpose of this clause, the recommendation of the guidance note is that you will have to obtain the certified copies of the deeds if at all there is a change during the year, and accordingly the fields have to be filled up. If you are using a private software, then it will fill up the data as per the previous year's Form 3CD, but you will have to ensure that they are correctly mentioned by verifying them. If there is no change, then the same data can be incorporated, but if there is a change in the partnership profit sharing ratio, then accordingly an amendment has to be made in Form 3CD also. Nature of business is required to be reported in Clause 10. Clause 10 simply says that the nature of business or profession has to be reported along with the codes which are given, and if there is any change in the nature of business or profession, accordingly the changes have to be disclosed in Form 3CD. Now, what is meant by change of nature of business? What is meant by the respective codes? The list of codes for each business has been given in Appendix 16 of the Guidance Note 2025. So if you wish to go and see the codes, instead of seeing them in your ITR, you can as well verify them in the Guidance Note itself. But where the SSE has added new lines of business in the current year, I mean in the financial year 2024-25 or in the previous year 2024-25, then all those additions or where there is a discontinuance of an existing business, to that extent the discontinuation has to be reported. And what should be reported should be a permanent discontinuance and not a temporary discontinuance. For example, for some reason the SSE has suspended a particular business activity for a period of 3 months or 4 months just before the year closure, and he would intend to revive it after 6 months or 8 months. In those cases, that would not tantamount to deletion of a business or discontinuance of a business or a change in the business. So to that extent, anything other than temporary has to be reported under this clause. Additions or deletions of new line of activity other than temporary would have to be reported. If at all an SSE is taking up a temporary business, a new business which he is taking up on a temporary basis, then that new line of business need not be reported in this clause because it is only temporary. For that, the guidance note asks the auditor to review the minutes of the meetings, the business reports, to see what kind of business reporting he is doing as far as the nature of business is concerned. Is he classifying the nature of business into business verticals and is he reporting them? Is there any kind of permanence to a business entity, a business activity? In that case, you'll have to report that businesses in the nature of business. If that is not there, then you will have to straight away report the nature of business along with the respective codes given in Appendix 16. For this purpose, the institute also recommends that you verify the GST registration number. Now, along with this data, the QRB also has the data of an annual report. In the annual report also, the business of the SSE are reported as far as Companies Act is concerned. There are some NIC codes where the activities of business are reported using those NIC codes. In those cases, the TAQRB found that what is reported in Form 3CD differs with what is reported in the annual report of a company. In those cases, the QRB had raised objections. So for all companies which are SSEs, the auditor needs to ensure that the annual report also contains the same nature of business. If at all it is not there, if the annual report is not produced before you, by the time you finalize your tax audit report, then probably you will have to give an adequate disclaimer to this effect as far as the clause 10 of Form 3CD is concerned. Clause 11 talks about the books of accounts of the SSE. Books of accounts, as you all know, are the prime basis which form the foundation for the audit. So with regard to books of accounts, the disclosures are quite elaborate in Form 3CD. Form 3CD says whether the books of accounts, the first question of Form 3CD in clause 11 is that whether the books of accounts are prescribed under 44 AA of the Income Tax Act. 44 AA subsection 1 prescribes the books of accounts only to specified professions. It does not prescribe the books of accounts to every SSE. 44 AA mandates that every SSE should maintain books of accounts if his turnover or gross receipts cross a particular threshold. To that extent, there is a guidance given in section 44 AA that every SSE is required to mandatorily maintain books of accounts. What are the books of accounts to be maintained is not given by given by section 44 AA. Section 44 AA only prescribes the books of accounts for a specified professional. For all other businesses or for all other non-specified professions, the books of accounts are only mandated to be maintained, but they are not what are the nature of books of accounts to be maintained are not prescribed. So understand this difference. Mandating the maintenance of books of accounts is different from prescribing the books of accounts. In prescribing the books of accounts, the section says you will have to maintain cash book, journal, ledger, all these are prescribed. But while for business and for non-specified professions, the section only mandates that you will have to maintain books of accounts. What kind of books have to be maintained is not prescribed by 44 AD. This distinction has to be understood separately. The list of books of accounts maintained and the address at which the books of accounts are to be kept also have to be reported under this clause. What are the books of accounts that are maintained and the address at which the books are maintained also have to be reported under this clause, and the list of books of accounts and the relevant documents examined. The third limb is in the second limb you will have to list the books of accounts maintained, and in the third limb you will have to disclose the list of books of accounts and the relevant documents which are examined. So to that extent, what is maintained, what is examined also have to match together. Section 2 clause 12A defines books of accounts as including ledgers, day books, cash books and other books in written form or in electronic form or in digital form or in printouts. So to that extent, you can maintain your books of accounts even in a soft copy. You can maintain them on a server which is located within your business premises, within the client's business premises, or the books of accounts could be maintained in a cloud form also. Now, what is the responsibility of the auditor as far as the maintenance of books of accounts is concerned? The recommendation of the guidance note is that 44 AA read with Rule 6F only talks about prescribing the books of accounts for specified business. For non-specified profession or for business, no books of accounts have been prescribed. So accordingly, if your client is a person carrying on business, then whether books of accounts are prescribed under 44 AA, for the first question you will have to report the answer as no, not yes, because only for a specified profession the books are prescribed. Therefore, for business case or for a non-specified profession, you will have to report the first answer to the first question as no, not as yes. Now, if the books are maintained at the server, ensure that the server is also located at the registered office address, and accordingly you can mention the name or a place where the server is located. If the books are stored online, then you will have to report the IP address of the cloud server as the place where the books of accounts are maintained. So understand the difference. If your books of accounts are maintained on a physical server, then you will have to report the place of location of that physical server if that physical server is located within your business premises. But if your books of accounts are maintained on a cloud, then to that extent you will have to mention the IP address also of the books of accounts where it is stored on a cloud. Effectively, if your bookkeeping activity is within your premises, you will have to report that premises. If it is located on third-party servers, then you will have to report the IP address. The auditor should also verify the specification as to which books of accounts have been maintained in the computer system and which records have been maintained in the hard copy. So if the vouchers and others are maintained in the bills, vouchers and all other expenditure related and income related documents are maintained physically, and it is only the entries which are maintained in the electronic form, then you will have to state what is maintained in the computer form and what is not maintained in the computer form. What is maintained in the hard copy form also have to be demarcated and written separately in clause 3C, in respectively in clause 11 of form 3CD. The QRB had a host of non-compliances. The first one, as I said earlier, for companies, no books of accounts are prescribed, but most of them wrote the answer as yes. Therefore, the QRB raised that the first question for company should always be said as no, because a company can never carry on a specified or for that matter any profession. So a company can only carry on a business. Therefore, for companies, the answer to the first question can only be a no. It can never be an yes. So to that extent where yes is marked, the QRB has raised an issue. The second, location of maintenance of books of accounts is not reported while the same is required as per the format. So location of maintenance of books of accounts has to be mandatorily reported in form 3CD, failing which it will be a non-compliance with the reporting with the guidance note issued by ICAI. Also, if they are not maintained in the report computer form, you will have to report accordingly. Where you have maintained in the computer form, but you have said they are not maintained in the computer form, computer system, then it will be treated as non-compliance. Similarly, where there are other documents like bills, vouchers, receipts, debit notes, credit notes, to that extent you have not mentioned them as a part of the documents you have verified in the books of account schedule, it will be treated as not proper reporting as far as clause 11 read with the guidance note is concerned. Especially vouchers, receipts, debit note, credit notes, inventories, or all other invoices or whatever you have examined like bank statements, agreements, all that have to be reported in the documents which have been examined. So that will ensure, that will not only give a credence to the fact that you have verified it during your audit, it will also substantiate the proper disclosure under clause 11 of your form 3CD. So QRB is very meticulous in examining the documents verified and the reporting which has taken place for various companies under clause 11. Now we'll quickly go on to clause 12. Clause 12 states that the profit and loss account, if it includes any profits and gains from businesses which are forming part of your presumptive tax, then to that extent you will have to report what is the amount of profit or gains from those presumptive taxation. There could be instances where an assessee could have multiple businesses. Each business could be covered by a different provision of form 3CD. In those cases, if at all the assessee is opting for presumptive tax for one kind of business and he is not opting for presumptive tax, he is opting for 44AB for other businesses, you will have to accordingly report the different categories. I'll give you one example. An assessee is engaged in retail trade. Apart from retail trade in textiles, the same assessee is also engaged in transportation of goods. The transportation of goods is covered by 44 AE, where the SSE owns less than 10 vehicles. In those cases, if he is having less than 10 vehicles, for the purpose of business engaged in transportation of goods, he can opt for 44 AE, and for the retail trade business that the SSE is having, he can continue under 44 AB. So he can choose whether he can opt for 44 AE for that goods carriage business or not. If he is not opting, he can combine both and go to 44 AB combinedly for both the businesses together. Where the SSE is having multiple businesses and he is opting presumptive taxation for one business and is excluding the others, in that scenario, we'll have to ensure whether separate set of books of accounts are maintained or not. Because for the SSE liable for audit under 44 AB, separate set of books of accounts have to be maintained, and the expenses and the incomes should correspond to that business alone. If he is not maintaining separate set of books of accounts, then you will have to ask the SSE to bifurcate both the businesses and show us the books only related to 44 AB. If the SSE says he is not able to give separate books of accounts, then you will have to ensure that your audit is only with respect to the SSE to the business which is covered by 44 AB. To the extent presumptive income is there, that has to be reported under this clause. But even if there are two separate set of books of accounts, how does the SSE apportion the common expenditure? For example, he could borrow one loan and utilize that loan towards both the businesses together. Then how do you apportion the interest? How do you apportion common head office expenditure? How do you apportion audit fees which is charged? If at all the SSE is having, how do you apportion GST fees, or how do you apportion various other fees which could be common to both the businesses together? In those cases, it would be a challenge, but on some reasonable basis, the common expenditure has to be allocated, and the books or the accounts relating to audit have to be audited under 44 AB alone. So if at all the SSE is opting for presumptive tax, to that extent, the profit from those books of accounts maintained separately have to be picked up and put here for the purpose of reporting under clause 12. Now, what happens if the SSE says that I have maintained books only for the purpose of 44 AB? Therefore, if I am opting for a presumptive tax, then to the extent of presumptive tax, I will not maintain books of accounts. Is this the right argument of the SSE? The SSE could rely upon 44 AA read with 44 AD, and he can state, if I am opting for 44 AD, the section very clearly says I need not maintain books of accounts. Therefore, 44 AA is not applicable to me, and therefore I have not maintained books of accounts. That could be the argument of the SSE. Nevertheless, we should, or the auditor of the SSE should impress upon him that he should maintain books at least for the purpose of determining the correct gross receipts, because 44 AD or 44 ADA, for that matter, levy, both the sections or even the other presumptive sections like B, BB, BBA, levy tax on the gross receipts of the SSE, on the turnover of the SSE. So at least to the extent of determining the turnover or gross receipts, SSE should maintain books of accounts. If at all it is not perfect with regard to other aspects, then he need not worry. But at least with regard to determining the turnover on which the presumptive tax is collected, at least to that extent, he should maintain books of accounts which are proper and which are helpful in determining what is your correct turnover as far as those presumptive sections are concerned. To that extent, he'll have to maintain books of accounts. So essentially, every SSE who is going under presumptive tax is not completely required to throw away his books of accounts. He'll have to maintain them to the extent it is necessary for the purpose of determining the aggregate gross receipts or turnover or your sales. That was with regard to presumptive taxation. Books of accounts and presumptive tax. Now coming to clause 13, 1 to 13 is the first part of my session, and clause 13 is the last point in my first part of the section. Second part would deal with clause 19 to 29, but in the first part I will restrict myself from clause 1 to clause 13. Clause 13 is again an elaborate clause. It talks about the method of accounting followed by the SSE. What is the method of accounting followed by the SSE? Whether there has been a change in the method of accounting followed by the SSE when compared with the immediately preceding previous year. So in the immediately preceding year, what is the method of accounting followed? In the current year, what is the method of accounting followed? If at all there is a change, then to that extent, you are required to give the effect on the profit and loss account. Now, for a company, the method of accounting is mandatorily required to be accrual. A company cannot have cash basis of accounting. So a company has to mandatorily maintain its books of accounts on accrual basis of accounting only. If at all the SSE, being a non-corporate, changes his method of accounting either from mercantile to cash or cash to mercantile, he is free to change his method. There is no restriction with regard to change in the method of accounting. He is free to change his method of accounting. But the only criteria here is that he should thereafter consistently follow that method of accounting. 1 year he can't be in mercantile, second year he can't be in cash, third year again he can't be in mercantile. He can't keep on changing his method of accounting. He has to follow the method of accounting consistently. There cannot be a change in the method of accounting. So for all practical purposes, if at all an SSE is changing the method of accounting, in the first year, he will have to see what is the effect of that change on his profitability. So if at all if SSE was erstwhile following cash basis of accounting, he is now shifting to mercantile system of accounting. He will have to show how much the profit rose or how much the profit declined. To that extent, he will have to maintain the necessary record. Similarly, if an SSE is moving from mercantile basis of accounting to cash basis of accounting, then he will have to calculate what are all the payable entries coming at that year end, and he'll have to see what is the effect of those payable entries. Is it increasing my profit or decreasing my profit than what is reported through cash basis? So accordingly, he will have, for that first year alone, he will have to report what is the effect of that change as far as the method of accounting is concerned. In the second year, if he is following the same method as the first year, then none of the disclosures would arise. He would only say my method of accounting is this, and there has been no change in the method of accounting. So none of the disclosures mentioned in C would arise in the second year of change. In the first year of change alone, he will have to report those details of change. Now, apart from method of accounting, clause 13 also talks about ICDS. Clause 13 also talks about ICDS. It says wherever there is a requirement to, wherever there is an adjustment required to the income on account of ICDS, you will have to accordingly report the change in the methodology as far as the ICDS is concerned, and accordingly give whether the profit has increased or profit has decreased. There are lots of places where your profitability could get impacted due to ICDS. For example, a very small and simple example could be where you are recognizing revenue on completed contract method, but your ICDS says where the nature of service exceeds 90 days, you are mandatorily required to follow proportionate completion method. There, in your books, you would have followed completed contract method, but for the purpose of ICDS, you are mandatorily required to follow proportionate completion method. The moment you follow proportionate completion method, your profitability could either go up in the initial years or come down in the subsequent year. So accordingly, the change in the profitability has to be reported where you are following ICDS. As I said in the beginning of my lecture, that the ICDS is only for the purpose of your computation. It is not for the purpose of your books of accounts. So to that extent, any increase or decrease in the profit due to implementation of ICDS would only be required to be given in Form 3CD or in your computation. It has got nothing to do as far as your books of accounts is concerned. Similarly, one another example of ICDS changing your profitability when compared with your books is your foreign exchange fluctuation, where you are following foreign exchange fluctuation. All gains or losses on account of either measurement of the currency at the time of payment or on account of revaluation, they are all taken to your P&L account. But for the purpose of ICDS, there could be a difference where they would require that the capital foreign exchange fluctuation arising on account of capital expenditure has to be either ignored in 1 year, or it has to be taken to and added to the cost of the asset in the subsequent year. So on account of that also, there could be changes in ICDS versus book profit. Even as far as securities is concerned, normally if the SSE is having a intraday business of trading in shares, then at the year end you will have to decide whether you will follow cost or net realizable value, whichever is lower, for the purpose of determining your closing stock. For a normal inventory, you would have followed cost or net realizable value, whichever is lower. But as far as securities is concerned, you will have to take them as a class. Shares are treated as a class. There are different kinds of securities given in the Securities Contract Regulation Act. There, for each class, you will have to see what is the cost, what is the net realizable value as a class as a whole, and accordingly decide which is lower. So therefore, your valuation of your closing stock as per books could be different from the valuation prescribed under ICDS 8. So to that extent, you will have to either increase the profit or decrease the profit accordingly. So therefore, please be very, very careful. Accordingly, ensure that correct reporting is done with regard to ICDS is concerned. Whether the profit increases or decreases for the purpose of ICDS, disclosure is mandatory. So if at all you hold inventories, if at all you are engaged in construction contracts, or if at all you have revenue from other than construction contract, then you are supposed to give the disclosures given under each ICDS. So ensure that all the disclosures as far as the ICDS mentioned in 1 to 8 are concerned. There are 2 ICDS which are removed here because they don't have any disclosure requirements. For all the other ICDS, other 8 ICDS, you will have to give the disclosure requirements as mentioned in the ICDS in Form 3CD itself. So under clause 13, you will have to ensure what is the disclosure requirement of that standard, and that particular disclosure requirement has to be disclosed here. For one ICDS, there could be multiple disclosures. There could be 2 or more disclosures. That also has to be given here. For some reason, if you are unable to fill the respective field in detail, then you can prepare an annexure to your balance sheet, attach it with your balance sheet, but you will have to invite the attention to that annexure in this column of clause 13. So to that extent, make a reference to that annexure if at all the space is not sufficient for the purpose of disclosure under clause 13 of Form 3CD is concerned. Now, QRB, while examining these disclosures that have been given as far as the ICDS is concerned, it said that if an adjustment is required, then you will have to say yes in clause 13D. That means under clause 13, whether any adjustment is required to be made to the profits, if there is an adjustment, you will have to say yes here. Then this E will open. Here you will have to make adjustments. Most of the people were saying no here, and they were only giving the disclosures as per ICDS. The QRB said that is not the correct way of disclosing. Wherever there is a requirement to disclose, then you should say yes as an answer to clause 13D, and accordingly give the disclosure or the increase or decrease in clause 13E. It should not be disclosed in 13F is the intention of the QRB as far as the first issue is concerned. 13F disclosures have to be made, but in few cases it was observed that disclosures were not made. So to that extent, the QRB cautioned the members that 13F disclosures with regard to ICDS are mandatory. You have to necessarily disclose them even if you are following regular accounting standards, is the view of the QRB. One very bizarre or very difficult point which I felt I could not understand was this language picking of the QRB. QRB said the language of ICDS is cost or net realizable value, whichever is lower. And AS2 says lower of cost or net realizable value. So most of the people, most of the members, while disclosing on Form 3CD, they were only using this language interchangeably. And QRB said there is no question of interchange of language, although both of them give the same meaning. The language must not be interchanged. For ICDS, you should always use the language cost or net realizable value, whichever is lower only. As far as AS2 is concerned, you should use lower of cost and net realizable value. So they said or and should not be replaced and the language should not be changed. Effectively, I believe the same essence is carried on, but I fail to understand why the QRB was so particular in handpicking this wording and saying interchange of language is prohibited. Nevertheless, it is advisable to follow the advisory given by QRB in saying that para 3 of ICDS language cost or net realizable value alone should be used. You cannot use any other language other than what is prescribed in ICDS 2. With this, I have finished first part of my session related to clause 1 to clause 13. We'll now quickly take up some of the very important clauses appearing from 19 to 29. 19 to 29 deal with clauses which are required to be given in respect of your items appearing in your P&L account, profit and loss account. So what are those items and what are the disclosures which are required to be given here? Clause 19, I have not mentioned clause 19 because I found it to be quite easy to disclose. There is nothing much involved here. But nevertheless, I will briefly explain clause 19. Clause 19 deals with amounts admissible under other sections. Essentially, it is basically a disclosure under clause 35, clause 35.1 to clause 35.2ab, which is dealing with scientific research activity under 35.1.1. Scientific research where it is carried on by in-house R&D center, it is 35.2ab. Where you are giving a donation to a scientifically approved organization, then it is under clause 35.2aa. Capital expenditure is covered under 35.1.4. So all that where there is a specified business, you will have to give under clause 35. There is a respective clause. Your preliminary expenditure is covered under 35D, and there are other clauses where you will have to give the details. All those clauses have been mentioned in clause 19 of Form 3CD. Basically, you will say you are claiming a deduction under which clause, how much is already claimed in P&L and how much you are claiming as far as that clause is concerned. You will have to break up your deductions under that respective clauses and accordingly disclose these amounts. Basically, the majority of them are dealing with scientific research. Others are other expenditures where it have to be given. One query that I saw was how should we disclose CSR expenditure as far as section 35 is concerned, was one of the query that I saw. Basically, CSR expenditure is no longer an allowable expenditure. So if you are having a CSR expenditure to which you have paid, then if it is falling within your CSR, then you will have to necessarily disallow that amount of expenditure under section 37, because CSR expenditure is not treated as incurred for the purpose of your business or profession. Therefore, CSR expenditure will have to be disallowed under 37. But if at all the person to whom that expenditure is paid is a trust holding an 80G certificate, then you can claim deduction under 80G provided you are opting out of your 115 BAA or 115 BAB or 115 BA for that matter. If at all you are opting out, then you can claim 80G on that. There have been numerous decisions from the tribunals and the high courts that the act has clearly disallowed only under 37. The act has not disallowed the deduction under 80G. Therefore, if at all you intend to claim 80G, you can as well claim 80G for your CSR expenditure, provided you are opting for the old regime, which is not the default regime. Under default regime, there is no deduction permitted. Therefore, you will have to simply disallow the expenditure under 37 and not claim any deduction as far as 80G is concerned. So that was with regard to clause 19. Clause 20. Clause 20 is divided into two parts. One, any sum paid to an assessee, to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profit or dividend. So if for an assessee, you have paid certain amount as bonus or commission, But if without that amount payment, the same sum would have gone to him as profits or dividend. In those cases, such payment could be disallowed under 36(1)(2). So accordingly, you will have to mention how much is payable under, how much is disallowable under 36(1)(2) as far as clause 20 is concerned. Now, if it is a genuine payment, the basic premise under which 36(1)(2) was introduced was that most of the people were trying to avoid dividend distribution tax by making the payment as salary or as bonus or as commission. So to the extent it is paid as bonus or commission, if there is a corresponding amount which could have earned him as, which could have been given to him as profit or dividend, then to that extent the amount stands disallowed. But if it is a genuine case of payment, especially commensurate with regard to the services that he has rendered, then there is a possibility that the payment could not be disallowed even though the employee is a shareholder. Therefore, to that extent, 36(1) need not be invoked. So please ensure adequate caution when you are disclosing under clause 20 subclause A of Form 3CD, which talks about 36(1)(2). As far as clause B is concerned, clause 20 subclause B is concerned, it talks about providing the details relating to contributions received from employees for various funds referred to in 36(1)(5)(a). Basically, it talks about employees' contribution towards PF, ESI or any other employee welfare organizations. Till 2024 or 23, I believe, there was a dispute with regard to the type, what is the nature of contribution received from employee. It was always treated as employer's contribution only, because employer was the person who was paying to the welfare funds. Therefore, it was ultimately treated as employer's contribution. But the Honorable Supreme Court in Checkmate Services very clearly said that 36(1)(5)(a) and 43B do not have an overlap. 43B operates only with regard to employer's contribution. 36(1)(5)(a) alone operates with regard to employee's contribution. So after this decision, employee's contribution collected from the employee as a deduction from his salary has to be paid within the due date specified under the respective act. In the case of PF Act, 15th of the subsequent month is the due date mentioned. In the case of ESI, 21st of the subsequent month is the due date mentioned. Within that respective time, the employee's contribution has to be paid. If it is not paid, if it is paid beyond the due date, to the extent it is paid beyond the due date of that respective statute, the contribution collected from the employee will become income, but it will not be treated as expenditure even though it has been paid. So to that extent, please be very, very careful. If the employee's contribution is not paid within the due date prescribed under the respective statute to which the contribution is being made, then it would be treated as the income of the employer. Therefore, even if you are paid subsequently, it will not be allowed in any other year. It will be a permanent disallowance, or it will be treated as a permanent income, which will be unnecessary for the employer. Please be very, very careful. If you have failed to remit it within the due date, it stands to be disallowed. Even if there is a delay of 1 day, it is sufficient to call for the disallowance. Therefore, please be very, very careful while reporting under clause 20 subclause B of the Form 3CD. Observations of the QRB was that in certain cases the details pertaining to provident fund have been reported, but ESI was not reported, where there was clearly payment and reported in the annual report of the company. So where the SSC had both provident fund and ESI, the auditor only reported the provident fund details but did not report the ESI, then to that extent it was treated as irregularity by the QRB. Not just provident fund or ESI, if the SSC is having any other defined contribution plan, then to that extent all those have to be reported in this class for the purpose of 3CD. You cannot choose one and choose to ignore the other. Everything has to be reported mandatorily. The due date under the relevant statute has to be given, not any other due date. Your due date is not the due date of filing of the return. Due date is the due date as per the relevant statute. As per the PF Act, what is the due date? As per the ESA Act, what is the due date? That due date has to be filled correctly in the disclosure form of the clause 20 of 3CD. Now, clause 21 dealing with section 37 has been amended. In fact, section 37 itself was amended to include various items. It was amended to include various offenses which are treated as expenditure incurred for any offense which is treated as not for the purpose of, wholly for the purpose of business or profession. So there has been insertion of explanation 3. We will see what it is, but essentially corresponding to an amendment made to section 37, the entire clause of clause 21, has been amended. Originally, if you see clause 21, it will have what is capital expenditure, what is personal expenditure. That capital expenditure, personal expenditure, advertisement in a brochure, maintenance of payments to or expenditure incurred at clubs, all those old conditions continue to remain. But what has been amended is the corresponding amendment made in section 37. Nowadays, I find it more recent trend that wherever there is a change in the law and wherever there is a change in the form tries to pick the language, whatever is mentioned in the law, and puts it in the form for somebody to report on that item. So they have not indulged in extraordinary thinking. They have simply lifted the language present in the section and they have put it in the form for reporting. Now, whatever is there in explanation 3 to section 37(1), same language has been given in form 3CD also. There are 4 components to explanation 3. If you carefully look at the definition of, if you look at the language of 37, any expenditure which is wholly or exclusively incurred for the purpose of business or profession shall be allowed as shall be allowed in computing the income of the assessee. This we all know. Section 37 is the last omnibus section which allows expenditure, provided it is not in the nature of capital expenditure, it is not in the nature of personal expenditure, and it is incurred wholly and exclusively for the purpose of business. So what is wholly and exclusively? It is not the quantum, but it is the purpose of that expenditure. Purpose of that expenditure must be wholly and exclusively for the purpose of business or profession. Having said that, they have introduced explanation 1 long ago, which said where any expenditure is incurred for any purpose which is an offense or prohibited by law, then such expenditure shall not be deemed to be incurred for the purpose of business or profession. So expenditure incurred for any purpose which is an offense in the law shall not be treated as expenditure incurred wholly and exclusively for the purpose of business or profession. Now, what is expenditure incurred for any purpose which is an offense under the law? This has been explained in explanation 3. Explanation 3 says, for the removal of doubts, it is hereby clarified that expenditure incurred by an assessee for which is an offense or prohibited under law means 1, 2, 3, 4. These 4 would constitute expenditure incurred by an assessee for a purpose which is offense or prohibited under the law. The same 4 items have been picked up and put in form 3CD for the purpose of reporting. What is the first item? For any purpose which is an offense under or which is prohibited by any law, if you are incurring an expenditure which is an offense under a law, then that expenditure is treated as a not allowable expenditure under section 37. 37 only talks about expenditure. It only talks about expenditure, not about loss. It does not deal about allowances. So expenditure is very, very critical. Expenditure must not be incurred for the purpose of for a purpose which is an offense under a law. For example, there was if the businessman engages in giving bribe to a government servant or to any other person, then that bribe is an offense under a particular law. Then to that extent, the bribe so received or this bribe so given would not be treated as an expenditure allowable for an assessee. Similarly, if you are providing any perquisite or benefit to a person which is in violation of any law, rule, or guideline, then such expenditure, benefit or perquisite, is also not treated as an expenditure. This second limb is mostly applicable in a medical profession. In fact, that is the whole purpose with which they have introduced this. The third limb deals with compounding of an offense under any law. If you are trying to compound an offense, then any expenditure incurred to compound an offense, it could be your lawyer's fees, it could be the fees that you pay under that respective law, it could involve legal consultation, it could involve several other expenditure. All that expenditure has to be clubbed and disallowed under section 37 in clause 21. Similarly, if there is any expenditure incurred to settle proceedings initiated in relation to contravention under any law notified by the central government, then that settlement proceedings, expenditure incurred in the course of settlement proceedings, will be treated as disallowable under section 37. One word of caution here is that the Honorable Supreme Court, in the cases mentioned on your screen, said there is a distinction between expenditure which is compensatory in nature and expenditure which is penal in nature. Only which is penal in nature will stand disallowed under 37. What is compensatory in nature will not stand disallowed under 37. Similarly, if expenditure is composite in nature, that means it is both compensatory as well as penal, then only to the extent it is penal stands disallowed. You will have to bifurcate what is penal, what is compensatory. Only penal portion will have to be disallowed and compensatory portion will have to be allowed. Therefore, that is why interest on all late payments or interest paid to any under any statute will have to be treated as an allowable expenditure. Except income tax law, any interest paid under any other statute is always treated as an allowable law. But what is the position with regard to late fees, late filing fees, or late fee paid? Is it penal in nature? For this, the QRB stated that late filing fee for TDS return or late filing fee under GST is not a penalty levied. It is only a facility extended for late filing. Therefore, it is not, the late filing fee is not required to be disclosed under clause 21 of 3CD. It is not penal in nature, therefore not required to be disclosed. So what does the guidance note say with regard to compounding of offenses? The guidance note only says that examine the nature of litigations that are going on, take a management representation letter, examine how many are relating to compounding. Correspondingly, for that compounding application, what is the fees paid, what is the lawyer fees paid, or what is the other charges that you have incurred, all that compile and try to disallow as far as clause 21 is concerned. Now, we'll move on to the next important clause, which is clause 21B, relating with TDS disallowance, TDS and its related disallowance. Clause 21B talks about 40AI and 40AIA. 40AI is applicable to a non-resident. 40AIA is applicable to a resident. For a non-resident, the payment TDS, even if it is paid before the due date of filing of the return, the expenditure will be treated as allowed. But if the TDS is not at all paid, then 100% of that expenditure will be treated as disallowed. For a resident, even if the expenditure, the TDS is paid before the due date of the filing of the return, the expenditure is allowed. But if the TDS is not at all paid, then 30% of that expenditure will be treated as disallowable. So for a non-resident, if the TDS is not deducted, or if after deducting, if it is not paid, 100% of the expenditure stands disallowed. But for a resident, it is only 30% of the expenditure, not the entire expenditure. The 40AI section has been amended long time back to ensure that there is a parity between the payments as far as residents and non-residents are concerned. Both for residents and for non-residents, if the TDS is paid before the due date of filing of the return, the expenditure is treated as allowable. But Form 3CD, even now Form 3CD says paid during the previous year or before the expiry of time prescribed under section 201. The Form 3CD only requires you to give the payment of tax which has been paid before the expiry of time prescribed under 201. But the section has been amended to see that the TDS is paid before the due date prescribed under 139(1). So accordingly, even though the form requires you to give the amount paid before the due date prescribed under 201, you will have to necessarily ensure that the amount given here is the amount which is paid before the due date of filing of the return. Therefore, you will ensure that there is no disallowance arising to an SSE because the entire section has been amended, but the form has not been amended. Similarly, if at all the TDS has not been deducted, it does not bring to a conclusion that it will be liable for TDS, liable for disallowances. You will have to check whether you can collect Form 26A from the payee or not. If at all you can collect Form 26A, which is to be given in accordance with Rule 31 ACB, then you can collect that 26A and correspondingly treat the SSE as SSE not in default. Because the SSE is not in default, there will be an applicability of, there will be no disallowance under 40A IA, and therefore disallowance under disclosure under 21B also would not arise. So take into account Form 26A and ensure that it is obtained in cases where there is no deduction of tax by the SSE. First and second proviso of 40A IA have the effect of taking the disallowances for the respective year even though it is paid before the due date of filing of the return. There are very few cases where expenditure is allowed as a whole even though the TDS is short deducted. For example, for an SSE, I should have deducted TDS under 194J at the rate of 10%, but by mistake I have deducted under 194J at the rate of 2%. So for such short deduction, will you disallow the expenditure has been the question. There are few case laws which are favorable to the SSE, which are quoted and appearing on your screen. There are few cases which are not reported here and they are adverse to the SSE also. Don't use this as a weapon. You can only use it as a shield in case of assessment proceedings, but try to impress upon the SSE to deduct the entire amount of TDS instead of short deducting the TDS, because short deduction of TDS has multiple ramifications as far as the SSE is concerned. I believe TDS is not something which can be discussed standalone in class 21B for the simple reason that there is a whole annexure which has to be given after your 3CD. There is a whole table which has to be given. There, if at all there is a short deduction or if there is no deduction, it has to be reported in that table also correspondingly. So to that extent, ensure that class 21 matches with the table given in Form 3CD. Therefore, there is no major impact. Before trying to disallow, if the SSE has not deducted TDS, it is always good to disallow that expenditure or report the disallowance in Form 3CD, but also take into account the penalty and the prosecution which could arise. Therefore, advise your SSE to go for compounding of offence. You can refer to circular number 4 of 25, which is the latest circular on compounding of offences. Ensure that there is no impact as far as the prosecution sections is concerned. So to that extent, please be very, very careful as far as TDS reporting is concerned. That's why I said TDS is not something that can be discussed under one standalone clause. All the relevant clauses have to be tested to see how far you are reporting. In fact, if there is a short deduction, you will have to report it not only in the TDS table that is given, but you should also report it while giving the disclosure under the various TDS returns filed. In the end, it says, is the data filed in the TDS return accurate? You should say no, and you should also say that these have been TDS which have not been reported or which have been short reported. All that has to be presented. QRB raised several critical issues. It said most of the cases, the disclosure was not given party-wise. It was only given in one lump sum, saying that various expenses of sundry parties. That is not the correct way to give. You will have to disclose the data in clause 21 party-wise. Party-wise should contain the address of the party also. So party-wise disclosure is required, not lump sum disallowance under 40A. Similarly, the disallowances relatable to resident as well as non-resident have to be reported under the respective clauses. They cannot be reported in one clause under resident or under non-resident, respectively disclosures have to be changed. If at all you are not reporting differentially for resident and non-resident, it might lead to a query from QRB. And address of the payee also was not reported in few cases. These are all the 4 observations raised by the QRB with regard to TDS provisions. Please be very, very careful. If you are reporting, report it party wise, ensure that the party address is there, and correspondingly ensure that the party is either resident or non-resident. If it is a non-resident, you report it in the non-resident column, leading to 100% of the disallowance. If it is a resident, only 30% will be disallowed. So to that extent, ensure that it is accordingly reported. Similarly, clause 21D. Clause 21D talks about cash payments and disallowance under 40 capital A3 and 3A. 40A3 and 3A would come into picture where there is a cash payment for an expenditure exceeding 10,000 rupees per person per day. It is now applicable for capital assets also. If any capital asset has been purchased in cash, then to that extent the corresponding depreciation claim has to be disallowed. You cannot claim the depreciation. Therefore, please be very, very careful. If at all there are cash payments related to revenue expenses, you will have to disclose them in 40 capital A3. The QRB has raised the objection that the reporting was not done. It was only mentioned in clause 3 of form 3CA. But for all practical purposes, 40 capital A3 disallowance have to be reported exactly in the form required there. There are other clauses like 36(1)(3) or clause 23 relating to related parties. 36(1)(3) talks about interest allowability. Interest corresponding to business has to be allowed. If a loan has been taken for any personal purpose of the assessee or has not been utilized for the business, the interest on the loan which has not been utilized for the business will have to be disallowed. So therefore, ensure that the entire loan amount has been utilized in the business of the assessee. If it is not utilized, if he has personally drawn that loan amount, then to that extent interest stands disallowed. Please be very, very careful with regard to that portion. The related party transactions also, QRB has raised that the figures were not matching with the annual report. Annual report would require the total payment made including the service tax or the GST portion, while Form 3CD requires you to the expenditure charged to the P&L account to related party. So to that extent, there could be a difference. But please be very, very careful where you are reporting as far as your related party payments are concerned. We'll now spend some time, significant amount of time on this MSME because there is a change in the MSME disclosure in the current year. MSME Form 3CD is now amended. Form 3CD says that you will have to disclose the interest inadmissible under Section 23 of the MSME Act or the total amount paid during the year to an MSME. Out of that, what is paid within the due date specified in Section 15, what is not paid within the due date specified in Section 15 of the MSME Act. To that extent, there is a disallowance, and that disallowance has to be reported. This is the sum and substance of the clause 22 of Form 3CD. Now we'll go in detail with regard to what is the requirement laid down. We'll see what is an MSME. Up to assessment year 25-26, the limits of an MSME are different. Investment in plant and machinery, the limit is 1 crore for 10 crore and 50 crore for a micro, small and medium enterprise. For an annual turnover, the limits are 5 crore, 50 crore and 250 crore for a micro, small and medium enterprise. But this is only relevant for the assessment year 25-26. From assessment year 26-27 onwards, the limits have changed. Investment in plant and machinery has gone up to 2.5 crore, 25 crore and 125 crore. And turnover has gone up to 10 crore, 100 crore and 500 crore for a small, medium and a small, micro, small and medium enterprise. So examine what is the limit applicable for assessment year 25-26 and accordingly determine what is a micro, small or a medium enterprise. This is the classification difference as far as an MSME enterprise is concerned. Now, what does 43BH say? It says any sum payable by an assessee to an MSME, to a micro or small enterprise beyond the time limit specified in section 15 of that MSME Act shall not be allowed on an accrual basis. It shall be allowed in the year in which the actual payment has been made. This is the sum and substance of 43BH. It says if you have made the payment beyond the time limit specified in section 15 of the MSME Act, then the payment will be allowed on cash basis, not on accrual basis of accounting. This is the sum. It also says even if the payment has been made before the due date of filing of the return, I have nothing to worry. I mean, I am not give you as a deduction. You will have to see section 15 of the MSME Act only for the purpose of determining whether allowable or not for the purpose of 43BH. Now, 43BH came 2 years ago. This section was repeatedly discussed in various fora also. But still, there are some issues which require some amount of explanation. Now, in 43BH, if I do what does section 15 of the Micro, Small and Medium Enterprise Act say? It says if the due date agreed between you and the party is below 45 days, then you will have to pay within the due date agreed by you. If the due date is beyond 45 days, then I will restrict the due date to 45 days. That is the sum of section 15. It says if the due date agreed between you and the MSC, Micro and Small and Medium Enterprise is below 45 days, then whatever is the due date you agree is the due date you have to follow for making the payment. If your due date agreed is beyond 45 days, then by virtue of section 15, I will restrict the due date to 45 days is what section 15 says. So if the payment is made beyond 45 days, generally it will be disallowed. But if the payment is made before 31st of March of the previous year, that means for one financial year, if the payment is made after the 45-day limit, but before 31st March of that year end, then it will anyway be allowed because on cash basis of accounting, it shall be allowed. Only risk here is that because it is paid after that 45-day period, interest will run. And that interest will have to be necessarily paid, and that interest will also be not treated as an allowable expenditure for the purpose of income tax. So interest is the only worrisome part. But the payment which has been made would anyway stand allowed if it is paid before 31st March of that year. What happens when the bill is given in the month of March and the due date itself is in the month of April? For example, the bill was given on the 1st of March. The due date is 45 days. If the due date is 15th of April, and if I make the payment before 15th of April, the expenditure would be allowed for the purpose of financial year 24-25. But if the payment is made after 15th of April, even though the due date is falling outside the financial year, if the payment is made after 15th of April, then the expenditure will be disallowed for financial year 24-25. It will be allowed for the financial year 25-26. There have been scholars who have disagreed with this logic, but as chartered accountants, Institute in its guidance note has given this ideology. This example clearly demonstrates how you should calculate the disallowance. This is the example that I picked from the Institute guidance note. This is not my own example. This is the example I picked from the Institute guidance note. It says if the disallowance is paid within the due date, then it will be allowed in the assessment year 25-26. But if the payment is made after the due date, even though the due date falls outside of the financial year, it will be allowed only in the subsequent year, not in the earlier year. This is the example given. Kindly go through the example. It is very wonderfully given over there. Now, what does the form require us to disclose? Form says amount of interest inadmissible under 23. So wherever you are making a payment in delay to a micro, small or medium enterprise, then to that extent interest will have to be paid along with that payment. Interest is calculated at the rate of 3 times the bank rate. So heavy interest will have to be paid. And after paying that interest also, it will not be treated as an allowable expenditure. I have no problem with clause 1. But the clause 1 should have said and. By mistake, they have written it as or. I believe it is only a typographical error. They will correct it sooner or later, but basically that or should be understood as and. And in the second limb, they are talking about amount required to be paid to a micro small enterprise under section 15. It is the second and the third point refer to payments which are due in the financial year or in the previous year only. They are not talking about opening dues. Opening dues to MSME are covered under 43BH of that 43B disclosure of the Form 3CD. That is not covered here. It is only current year dues which are covered in clause 22. Earlier year dues are covered in the 43B of the Form 3CD. Therefore, only the current year dues are covered here. Here, they say what is the total amount required to be paid to an MSME, micro or small enterprise. What is the total amount paid? The total amount paid would include even capital payments. They did not distinguish that what is the amount allowable under the act and what is required to be paid. They did not use that language. They said total amount paid payable to an MSME. What is that amount is given here. Then they asked what is the amount paid within the time provided under section 15. To that extent also there is no problem. They immediately jumped and said what is the amount not paid up within the time prescribed under 15 of the MSME and inadmissible. But within these two, there could have been one more column which says what is the amount which is paid beyond the time prescribed in 15 but before 31st of March of the previous year or the financial year. That would also should have been given. Somehow there is a gap here. They could not properly link up. But I believe the last column, amount referred to in 2, which is not paid within the time prescribed under 15, section 15 of the MSME Act and inadmissible for the previous year, should only include items which are due as on 31st of March and the due date is after 31st of March and which are not paid within the due date. Only those amounts have to be written here, not just because what is not paid within the time of prescribed under 15, all those will not form part of 3B. Only those which are disallowable, which are inadmissible, will have to be reported here in the end. Not every payment which is beyond the time under 15. That is the sum and substance of clause 22. MSME reporting required to be made in the notes. Every note should contain this reporting. I will not go in detail due to shortage of time. Clause 41 talks about deemed income. Generally, if clause 41 is reported on the income side, clause 41 basically covers your bad debts recovered, your provisions which were earlier claimed as deduction and which are now reversed, all that which is claimed as a trading liability and earlier disallowance expenditure was claimed which is now recovered from the SSC would be reported under 41. Now, 41, if at all it is reported on the credit side of the P&L, you need not report in Form 3CD, but unfortunately, ICAI and QRB's views are different. They say that even if an item of income is reported in the P&L, credit side of the P&L, it is taken as income to the P&L, still the disclosure is required to be given in Form 3CD is the view of ICAI. But if at all this view is taken, then there could be a possibility of addition in the intimation. So please be cautious. Do not disclose every item of 41 here because it could lead to addition in the intimation. This is all about 43B. 43B, the erstwhile there was clause A, B, C, D, E, F, G. H was introduced to cover MSME payments. That whatever was mentioned in clause A to G, they have now just removed that phrase. They say everything covered under 43B have to be reported here. A 43B is again divided into two categories. First covers pre-existing liability which is paid during the year. This includes, first category includes MSME dues also. Second category refers to expenditure incurred during the previous year but not paid before the due date of filing of the return. The second clause does not include 43BH, which is dealing with MSME, because it is already covered under clause 22. So the first clause 26 part A, which is dealing with pre-existing liability, covers MSME payments, but clause 26 part B, which is covering with current year liability, does not include MSME because it is covered by clause 22. That distinction has to be borne in mind while making the disclosures under the respective clauses of 43B. Now, there were two decisions. Unfortunately, the Institute guidance note also has referred to these decisions, but has not explained them. First is the decision of Supreme Court in Modipan, where they said under the excise law, if you make an advance payment under the PLA, there was a personal ledger account under the excise law. If you made a cash payment under the PLA, it would be treated as an allowable deduction for the purpose of 43B. And the Honorable Supreme Court in Maruti Suzuki, it was a case where there was excess credit present under RG23A. This is a register under the excise law. It was RG23A dealing with credit. They said excess credit does not allow for deductibility under 43B. There were two contrary decisions. One was dealing with PLA, other was dealing with RG23A. Your PLA is nothing but your electronic cash ledger for the purpose of GST. RG23A is similar to your electronic credit ledger in your GST. So how do you reconcile these decisions? If at all you have made advance payment of cash in your electronic credit cash ledger, you can claim it as a deduction for the purpose of 43B, saying that I have made advance payment of liability. But if you have excess credit in your electronic credit ledger, you may not be able to claim excess credit as a deduction for the purpose of 43B. This is how you'll have to reconcile these two decisions as far as 43B is concerned. QRB raised an issue that whenever they say excise duty was passed through P&L account, most of them were reporting the fact as yes. They were reporting it as no, but they should have reported it as yes. So if your GST passes through your P&L account, then you should report here as yes. But if your GST is parked completely in your balance sheet, not touching your P&L account, then you can report it as no under this clause. Now, clause 28 and 29 dealing with 5626A and 5627B are omitted because the section itself was omitted. So 28 and 29 clauses of the Form 3CD are omitted. So I would not cover them. I'm considering that they are omitted. This brings me to the fag end of my session, where is the revision to a tax audit report permitted? Yes, the revision is permitted to a tax audit report under Rule 6G. If there is a payment as far as 40A IA is concerned, or 40A or section 43B is concerned, if at all there is a payment which is made after the due date of the tax audit report, after the filing of the tax audit report, but before the due date of filing of the return, if at all there are payments made with respect to TDS or with respect to 43B, then to that extent you can revise your audit report, perfectly legal as per Rule 6G of the income tax rules. Some precautions as far as the tax audits are concerned. As you all know, there are penalty sections under section 271J, reference to the Institute for Disciplinary Action where there is a wrong reporting, and prosecution under section 278 as a better of crime. So these are all possible actions that can be taken against a CA. Please be very, very careful when you are disclosing data as far as Form 3CD is concerned. If you are using private softwares like Winman, Computax, there are a number of private softwares. Please be very, very careful. Try and generate a paper Form 3CD, verify the content in the paper 3CD to ensure the reporting is accurate, and then proceed for filing using that private software. Ensure that adequate documentation alone will save a CA from penal action. So please ensure that there is adequate documentation available with you before filing the Form 3CD. These are some essential documents which are there. If it is a new engagement, there should be an appointment letter, there should be an engagement letter, there should be a no objection letter from the previous auditor. But if it is a continuing assignment, then there is no need for an engagement letter. Just a management representation letter, significant accounting policies, working papers, all this will be helpful. In fact, this time the guidance note, the book, whatever is there, 2025 guidance note contains a sample management representation letter and an audit engagement letter. So accordingly, take out those letters from the guidance note and modify it to suit your tax audit and then issue to your clients if at all required. With this, I end my session. I am open to take questions for the next 10 minutes if there are any questions. I thank you all for a very patient hearing, and I thank SIRC for giving me this opportunity. Over to you, Ratnavel, sir.
Sir,
Yes, sir.
sir, this is CA Anand Pallad from Kalburgi, Karnataka.
Yes, sir.
With
Please go ahead.
regard to disclosure in under 48(2)(b) payments,
Yes.
in case of partnership firms,
Yes.
if any transaction of payment is done to any of the relative of the partner,
Yes, sir.
so that has to be disclosed.
Yes, sir. Definitely it has to be disclosed. For example, husband makes a payment to salary or payments in the nature of salary to his wife or to his son. All that has to be disclosed in Form 3CD.
No, it is in case of partnership firm.
Correct. Partner's wife is an employee or partner's son is an employee. They're all relatives of the partner. Definitely it would fall within the ambit of 40 capital A to B.
Okay, thank you.
Sir, hi.
Hello.
Yes, sir. Yes, sir. Go ahead,
Yeah,
sir.
so hi, this is
Sir, your voice is little low, sir. If you can increase.
so hi, am I audible now?
Yes, yes.
Yeah, so this is Shankar Pavanasam from Chennai.
Yes, sir.
So I have a doubt regarding clause 8. So
Yeah.
so I have a case where for my client, his cash payments exceed 5%. The limits actually, and his turnover does not exceed the limit. So under what section do I actually present the report, sir?
What is his turnover limit, sir? It is exceeding 1 crore.
He's actually exceeding 1 crore, and his cash payments are actually his turnover is actually in excess of 1 crore, but does not exceed 10 crores.
But you have not maintained that limit within that limit, cash
Yeah.
payment and cash.
Yeah.
So it is clause A of 44 AB.
44 ABA is the
ABA, correct.
So the in this year's tax audit form, this up until last year, the clause 44 ABA had a provision in the form which specifically states provision where aggregate cash receipts and cash payments of business are exceeding. So in this year, the same section has been amended and it states that it 44 ABA is for those whose turnover is exceeding specified limits.
Turnover is exceeding?
Specified limits.
No. The specified limit is that 1 crore. No, 1 crore. If your turnover, I mean, your cash payments and cash receipts are below 5%, then it is up to 10 crores. But otherwise, 1 crore is the primary criteria.
So, if the cash payments or receipts are over the limits, I should actually report it in 44 ABA.
44 AB clause A.
Okay. Done. Thank you. This was my question.
Sir, this is Shantaram Shanai, sir.
Yes, sir. Please, sir.
From Cochin. My doubt is, one of my client, he is a professional. He is required to do that audit under. He's a lawyer actually. Even though his turnover is not more than 50 lakhs rupees, he is getting his accounts audited because of that percentage.
Okay.
So here what happened is after the March 31st, I think on June 3rd, he passed away.
Okay.
Now how to report that?
Good question, sir. Sir, in the India case, he is a professional. He is having, for him tax audit is applicable, but the SSC is no more.
Yes.
So for the previous year for which he had received the money, it is his legal heir who has to file the return on his behalf.
Yes.
Till the date of the death, the return has to be filed. The responsibility of filing the return is on the legal representative, who is the legal heir.
Yes.
After his death, if at all his estate is divided, then it will be on the individual status of the legal representative. Till the date of his death, on the name of the assessee who has deceased, it is the legal representative, legal heir who will file the return. So first determine who is the legal heir. Then you will have to do in the IT portal, you will have to add this person and the legal heir.
That has been done, sir. I am asking how to report in 3CD.
3CD, you will have to report the name of the assessee who has deceased only. There is no need to give the name of the legal heir. You can only give it as an observation in form 3CB that the assessee has passed away and it is the legal heir who is filing the audit report. But the name of the assessee should only be out of the assessee who has deceased, because the assessee died only after the year end, not before the year end.
Okay, sir. Thank you. Thank you so much, sir.
Sir, good evening, sir. This is Kritika.
Good evening, ma'am.
Yes, sir. Sir, with respect to this MSME reporting, whether any disclaimer can be provided that from the software they cannot able to generate?
Madam, MSME, madam, the disclaimer only helps a chartered accountant from the legal rigors. It will not help the assessee, it will not save the assessee from the legal rigors. So, if a chartered accountant in Form 3CD or in Form 3CD gives a disclaimer that I am unable to verify what is MSME, what is not MSME, I am not able to make a distinction, then to that extent, his responsibility is complete. But for an assessee, just because an auditor gives a disclaimer, the responsibility of an assessee is not over. So to that extent, you will have to educate the assessee and tell him, if at all there is a disallowance which could arise because you have not properly known who is your vendor, who is a micro or a small enterprise. A disallowance could come in future if the officer discovers, is something that you have to educate the assessee. But as you said, the disclaimer only helps the chartered accountant to cover his responsibilities.
Okay, sir.
Hello, this is Murli Krishna from Vijayawada.
Yes, sir.
My doubt is with regard to the rule regarding cash payments and cash receipts. My understanding is that cash payments include not only revenue outgoes but also capital expenditures. And as far as receipts are concerned, not only revenue receipts but receipts which are capital in nature. Is my understanding correct, sir?
Sir, I believe this is a question for yesterday's session, sir. Sir, your understanding is not fully incorrect, but I would say it is incomplete for a different reason. Sir, unfortunately, this cash reporting, cash receipts versus the total receipts has been placed in two different sections. I have not covered it today, but still I will try and explain. Has been put in two different sections. As far as 44AB is concerned, whatever you said is perfect. Cash payments would include all payments to all parties, irrespective of whether it is towards a capital expenditure, revenue expenditure, whatever be it is, a cash payment will be counted for the purpose of total payments. That is, cash payment and cash receipt, total receipts, including capital receipts, for the purpose of 44AB alone.
Perfect.
But when you come to 44AD, 44AD also talks about cash receipts only, not cash payments, only cash receipts. 44AD, why does it talk about cash receipts? The original limit of 44AD is 2 crores. But if you want, you can increase it to 3 crores. The presumptive tax, you can increase it to 3 crores. But there, the condition is the total, out of the total receipts, cash receipts should be below 5%.
Yes.
For the purpose of 44AD, the cash receipts is only the sale receipts, not anything else.
Okay, in that context.
In that context, it is different. But when you ask the query with respect to 44AB, whatever you said is correct. Cash receipts would include capital receipts also. Cash payments would include capital payments also. So they are under two different sections. If your query is with regard to 44AB, your understanding is complete.
Yeah, it's only with reference to 44AB, sir. Yeah.
Yes, sir.
And moreover, I couldn't attend yesterday's session, so I've been missed out that here.
Yeah.
Thank you so much.
Thank you, sir.
Any further questions?
Madam, recorded versions are available.
Yes, sir. They will be uploaded on YouTube in a few days. Maybe by next week, it'll all be uploaded on YouTube. And we will also be uploading the PowerPoint, which Sir will be sharing with us on the SIRC website.
Madam, all the PowerPoints will be uploaded in the SIRC website under the programs option, under which you can see the option called past programs, where you can download all the materials. Whatever shared by the faculties will be available there. You can download it, and videos also will be uploaded in the SIRC channel called by SIRC of ICI, the channel name, where you can see all the videos.
Chaitanya, sir, there's a query by CA Asha Sharma, which is a continuing query, which she's asked if you could reply. SSC death, any difference if SSC died before the year close?
Ma'am, the basic difference is that, as I said in the reply to that query, from the beginning of the financial year or the beginning of the previous year till the date of death, the income of the SSC will be taxed in the hands of the legal heir, but it is basically the income of the deceased. So the legal heir would only file the return in the name of the deceased only. But after the date of the death, if at all the estate is divided and shared among the legal heirs, it will be taxed in the individual hands, in the personal hands of the legal heir, not in the hands of the deceased. So if a person dies, say assume on 30th of September, then for the first half of from 1st April till 30th September, the entire income is taxed in the hands of the deceased, but it is only the return and the payment of tax which is made by the legal heir. But after 30th of September, if the estate is divided and sent to the legal heirs, then each individual legal heir will file it as his personal income. It will not be taxed in the hands of the deceased. It will be taxed in the hands of the legal heir separately as his individual income. Hope that answers the query.
I think there's one.
I believe book profit is something that is defined in the act itself. There is no need to see after ICDS adjustment. It is only what is defined in section 40A. So to that extent, you'll have to restrict yourself. No need to see after ICDS adjustment. I mean, basically, you'll have to take into account the computation of total income and all that will come. So it is purely as per that section. Strictly whether it is after ICDS adjustment or not is something that we'll have to compute the total income and see. I'm not sure your query is how do you take the total income? Is your query, or I'm not able to gather? If you can orally ask the query instead of typing, it will be more beneficial, I believe. TDS is made at the year end instead of quarterly, whether the same is to be reported, taking business income. Again, this query, I find it a little difficult to understand because TDS is required to be deducted as and when the payment is made, and that requires to be paid within the next month 7th. So if it is made quarterly, if you are deducting it and paying it on quarterly basis, then yes, you have to disclose it as late payment, and to that extent, if you are liable to prosecution because the delay exceeds the defined number of limits, then definitely you'll have to go in for compounding, or you'll have to pay tax also. That will be taken care by your TDS return itself. But yes, if your TDS return accurately reflects that, then there is no need to disclose. But if your TDS return does not reflect that, then you'll have to reflect it in you have to state it in the tax audit report.
Good evening, sir. CA Asha this side.
Yes, ma'am.
Sir, my query was regarding if that the business income is part of total income.
Correct.
Whether we need to see that, like if any only business income is there for the SSC, then it would definitely change due to ICDS after ICDS.
Yeah.
Whether we need to check the ICDS effect also for computing the partner's remuneration, or the book profit which I have calculated based on the profit and loss account, I will take that.
I believe you will have to take see, I will read explanation 3 for your purpose. Book profit would mean net profit shown in the P&L account computed in the manner laid down in chapter 4D as increased by the aggregate amount of remuneration and interest payable. So you will have to compute it in the business head, whatever is laid down in chapter 4D. So if it involves taking into account change of income due to the ICDS and other issues, you will have to take that also into consideration, and thereafter compute what is payable to the assessee. I mean, what is the allowable remuneration. So essentially, what is book profit has been defined in explanation 3. So that alone would come into picture. There is no other possibility to calculate any other figure here. I hope I have answered this to you. If there is further doubt, I'll take it. Yeah, thanks.
Hello.
Yes, sir.
Sir, I just have a small doubt with respect to the closing stock valuation.
Your voice is low, sir. Can you increase your volume?
I just have a small doubt with respect to the valuation of closing stocks.
Yeah.
The assessee is maintaining as per an exclusive method of accounting with respect to the GST. He is not considering the GST in the valuation of closing stock. It is maintained as a cost value or NRV, whichever is lower.
Okay.
But as our ICDS requires us to compute the income tax profit on an inclusive method, how do we go about that, sir? Do we just mention it in the ITR, or?
Sir, this would be dealt with by clause 14, sir, which is not scheduled for today. I believe it is for tomorrow. This is something that comes exclusively in clause 14, but I will still answer your query since you have raised it. Closing stock has to be, for the purpose of preparation of your financial statements, you are right in saying that you will follow the exclusive method. There is no second thought on that. But for the purpose of 145A, you will have to compute it on inclusive basis. The effectively your net profit, if at all it increases under 145A, it increases because of your closing stock getting increased due to addition of this GST component in the closing stock. So if you were to sell all your closing stock before the due date of the filing of return, you would also be paying the GST on that closing stock before the due date of filing of the return. Therefore, your profitability does not change. But for some reason, you are unable to sell your stock before the due date of filing of the return, then the GST loaded on that closing stock may not be discharged, may not be paid. Therefore, to that extent, there could be an increase in your profit because your GST on your closing stock remaining unsold would get added to your closing stock value under 145A. Therefore, for that reason, there could be a change in the profit. Therefore, ICDS requires you to increase to the extent of that unsold closing stock.
Unsold inventory as on the date of filing of the tax audit report.
Correct.
Okay, thank you very much, sir.
Thank you, sir.
There is one query asking to explain Rule 6G.
Rule 6G is basically talking about audit report, and within that Rule 6G there is a provision for revision of the audit report. Generally, the Income Tax Act only talks about furnishing of the audit report, the rule, but in a very special case where there have been payments made after the due date of filing of the tax audit report, but before the due date of filing of the return, then in those cases, Rule 6G requires an assessee to obtain a revised audit report for the payments that he has already made, which is after the original audit report but before the due date of the filing of the return. So all those extra payments made after the original report is issued will now get captured in the revised audit report. That revised audit report can be issued under Rule 6G. That is the sum and substance of Rule 6G.
Yeah, there is a couple of more questions on the chat.
Ma'am, I'll take
I
a minute
think,
to run
yeah.
through.
Will you be able to take it, or shall we ask him to send an email and?
An email would be a better one, ma'am. If at all there are any unanswered, I will try and answer them and I'll send it back to you. If there are any, any oral question can be taken up, ma'am. Written, I will have to distinguish what is answered and what is unanswered. If there are any oral queries, I'll be happy to take now itself. One I see is non-compliance of law and non-compliance of reporting are two separate aspects. One pertaining to client and one pertaining to CA for audit report. How to overcome this? Is there any specific standard format for the same? Very difficult question to answer, sir. Non-compliance of reporting, as you said, is rightly on the CA. In fact, the institute has gone out and issued a checklist for tax audit report also. It runs around 44 pages. The checklist has to be complied to ensure that proper reporting is given. Non-compliance with law, it is purely the case of the issue is on the assessee. But to the extent there is non-compliance with the law, reporting has to be there by the auditor also with regard to non-compliance with the law. If at all the auditor is not inviting the attention to the non-compliance with the law, then there also he is at fault. So there is nothing to overcome on this, sir. You'll have to comply with it. In what aspect or in what scenario you have asked this question, if you can elaborate more, I will be more specific with the answer. How to report cash gift of 20 lakhs received from spouse in Form 3CD. If 20 lakhs is received on a single day, then yes, it will come under 269 ST. If 20 lakhs is paid on a single day, then it will also come in reporting under 269 ST. It falls under different clauses than what I've explained today. I believe that should be sufficient. But if the cash gift itself is doubtful, if it is not from a genuine source, then you'll have to report it under 68 or the corresponding section. If TDS is not deducted on 100, then 30 will be disallowed. In Form 3CD, how much amount need to be reported? Is it 100 or 30? It is only 30 which has to be taken, because that is the only portion which is to be disallowed, not the 100 portion. I believe I have taken all the questions in the chat box, ma'am. If at all there are anything else, I'll...
Yes.
Sir, this is Santana Raman.
Yeah.
Yes, sir.
Raised one query. Donation paid, also interest and income tax also paid. These are all debited in profit and loss account. So
Okay.
which is disallowed for income tax return. But where to report this in the Form 3CD?
Donation paid is, what is that donation, sir?
Both ATG donations are there.
You can go to clause, 1 minute, sir. You can go to clause 21, sir. 21. What all you have said, sir? What are the nature of payments that you have said?
Donation paid to approved as well as unapproved trust.
Yeah, that can be given in clause 21.
I do not find the exact subclass of 21 because it is not suitable. That's why.
Correct. There is a problem, sir. But the class 21 was the erstwhile class where you were giving the disallowances.
Yeah.
To that extent, interest would be required under 3613. For that also, there is a specific clause in Form 3CD. There you will have to give it, sir.
But that 3613 is for payment to institutions, no? Bank loan.
3613 covers interest allowable for the purpose of business, sir. So that has to be given in 3613 only, sir. There cannot be any other place for interest.
Okay. Thank you.
Yes, sir.
Hello, this is Rangarajan. I have a question.
Yes, sir.
What if the company has not paid MSME throughout the year on 45 days and there is an interest calculated and they have neither paid the interest nor do they have any intention of paying the interest?
First of all, sir, if the interest is not accounted in the income and in the P&L account, then there is no disallowance arising on account of non-payment of the interest. So to that extent, the interest which is not accounted, you need not disallow it accordingly. So since it is not charged to your P&L, there is no question of disallowance. So if you have not paid interest throughout the year, then the only question for an auditor is, can you quantify that interest? If you can quantify and if you find it to be material, then you will have to report it in your Form 3CB, saying that to this extent, the accounts are not true and fair, the interest is not provided, therefore, the true and fairness gets affected. But if it is not material, you need not quantify it. I mean, you need not report it. Or even if you miss reporting, there is no harm in the, as far as the non-reporting or non-payment or non-accounting of interest is concerned. Assessee wise, yes, he will have an issue because under the MSME Act, the responsibility to pay interest lies on the assessee. To that extent, he will have an issue. Hope I have
Okay.
adequately understood.
Yeah. Thank you.
So friends, I think Chaitanya has actually been very comprehensive and covered everything very comprehensively and very patiently. Thank you very, very much, CA Chaitanya. I know that, I did impose a little upon you by asking you to take it at a very short notice, but we had planned this and suddenly it just came into fruition like this, and we had a number of members from across South attending, and thank you very much for clarifying all their doubts. In case anyone has any more doubts, you're welcome to send us an email. We will get it clarified from CA Chaitanya also. And as said to everyone, we will be uploading the YouTube as well as the PPTs on the website. So want to remind you all that you can attend the next session on tax audit on 6th at the same time. So thank you very much. Thank you very, very much, CA Chaitanya. I hope you will come back to us again for some other sessions also. Thank you. Thank you very much.
Good day.
Yeah, good day. Good day to everyone. Good day.